All right, man. I got 901. So we've got some people coming on. See Bettina, Daryl, Ed's on, Hamza, Josiah, Lauren. Got Lily's on here, Mike. All right, Mike got his first sale this last week. Good job, man.
Thank you, sir.
You broke the ice, right?
I
Cool.
did, and I really, really want to thank you for all those coaching sessions we went through because I really don't think I would have done it this fast without those.
Well, I certainly appreciate that. Yeah, that's what we do, man. Whatever we need to do to coach you and help you. So we appreciate you plugging in to all the training and just trying to help people get better and better. Um cool. So let's get this party started. um so I'm gonna take um I'm gonna take questions and then I have some other things I can cover later. So welcome everybody. If this is the first time you've been on this call, this is our Q&A, our sales Q&A call. And I gotta get the lighting in my studio down. It's our sales Q&A call. So basically what this is designed to do is, people for you to ask questions and even though you don't know what question to ask, you might hear something that you didn't think to ask, but then can learn from. And so a lot of cool things came up this week with different agents and kind of got me thinking about stuff that maybe I wanted to cover. So let's open it up. We'll open up the floor. Who's got questions? Anybody? That's not a beer. This is sparkling water, by the way. Although I could use a beer right about now. But okay, who's got issues? Who's got questions? Who's got challenges?
Hey Alex, it's Daryl.
Hey, Daryl, how you doing?
Good, buddy. So when it comes to mortgage protection, um, what I guess I understand how it works. So you're basically it's a decreasing term life insurance policy that's supposed to help someone, God forbid, a death for the breadwinner. The other person doesn't have to lose the property.
It's actually it's actually not a decreasing term. It's a level term product.
Okay.
So it doesn't decrease. And so that's one of the value propositions compared to some of the old style mortgage protection that did decrease over time. So you get the full benefit. So this is sort of the standard advantages, we call mortgage protection. And by the way, so this kind of brings up a few things. So I've had questions on mortgage protection because some people have been getting some of the older leads that are mortgage protection leads. And so the mortgage protection, sometimes you get into a conversation with a client that'll say something like, well, isn't this just life insurance? I have plenty of life insurance. And I tell them, I go, you have life insurance? Like, how much life insurance do you have? And they'll tell me, well, I have this $200,000 or $500,000 policy. I go, yeah, that's awesome. You know that life insurance protects your income for your family. Mortgage protection insurance protects your mortgage. So people buy mortgage protection so they have that life policy that's segmented for their mortgage, that designed to pay their mortgage off or pay a bunch of the mortgage off so that the surviving family can refinance. Your life insurance is income protection. Does that make sense, Joe? And so you and I know that it's under the category, the umbrella of life insurance, right? But in the client's mind, they're trying to lump it all in together. They think, well, I've got plenty of life insurance. I've got, $500,000, and their house is like 300,000, right? Well, that's why I say this is mortgage protection. Mortgage protection is designed to protect your home. Life insurance is designed to protect your income. So they have me coming out to your area tomorrow between 5 and 7, or the next day between 3 and 5. Which one's better for you? I'll go ahead and just book the appointment. But you need to make that distinction for the client so they're still willing to meet with you once you figure it out. And so if you start arguing with me, well, Alex, it's all life insurance. Well, yeah, it is. But let's take the $500,000 policy, and that their home's 300,000. So immediately you have 200,000 left, and the guy makes 100,000 a year. That's 2 years worth of income. And if the wife doesn't work, she better get her butt working, because 2 years worth of income, let alone paying off other debts so they can survive on whatever income's left. That's, and one thing is important is when you do run into that situation, it is, you got to get into that mode of differentiating also the amount of insurance they have, because some people will try to, think they have enough insurance. And so sometimes when I'm with, and I do this on in-home appointments, I go, okay, so your $500,000 policy. So let's take a look at how much insurance. So I write down on my notepad 500,000 at the top. They go, okay, so your house is what, 300,000? So let's take 300,000. So I go down the list. I go minus 300,000, and then I go, so that leaves us 200,000. Okay. Now, what is your income again? Your income's 100,000. Okay. So 200,000 is equal to 2 years worth of income to keep your family going. Okay. Now let me ask you a question. You have two young children, and would you want your insurance to also cover your children's college? Well, yeah, I mean okay. And so do you want your children, you want them to go to a really great school, or do you want them to go just to a state school? See it? Well, I want to go to a great school. Okay. So what would you consider a great school? Well, Stanford, Duke. I mean, I have them tell me, well, University of Dayton. Okay. And so do you know what the yearly tuition is today for University of Dayton? I don't know. It's 30,000. I correct them. I go, no, right now it's running about 50,000 or more a year. That's a good school. But let's say you can only afford a state school. So like University of Cincinnati, maybe you can get away with 15,000 a year. Okay. But you want to go to Grace. Okay. So you have 2 kids. Let's say you want a good school today. Today's dollars, 50,000 a year. By the time they get to college 10 years from now, that you're probably looking at 70,000 a year. So 70,000 times 4, that's 280,000 per child. You got 2 children. Okay. So now that is 560,000 to cover their college. Okay. So let's subtract 560,000 from 200,000, and that leaves you minus 360,000. Okay. I just shut up, man. I just shut up. I spend down their money, and they suddenly realize, number one, they don't have enough life insurance, and number two, they need another policy for their house, right? And so we're talking term insurance. But so to get back to Daryl's question, so when you talk about advantages of mortgage protection insurance, the standard advantages over credit life insurance, where it just pays off the balance, is number one, the premium stays the same throughout the entire period of time, and the death benefit stays the same for the entire period of time, compared to those bank programs that just pay off the mortgage. The second advantage of mortgage protection is that it follows you. It does not stay with your mortgage. So Joe and Mary, sometimes these mortgage protection programs that your bank offers is only for that loan. Okay. When you move and refinance or move, that policy goes away and you can't take it with you. So our mortgage protection policies are portable. In other words, you can take it with you regardless of the mortgage. And if you go to a bigger home, all we do is write another mortgage protection policy that will follow you for the difference. So let's say we write a $300,000 policy on you. You move into upgrading a home that's $500,000. Well, we just write another policy for $200,000. So all you have to do is cover that extra $200,000 value, and you have that other policy that stays in force, especially at the age that you bought it. So you might be 5 years older when you move, but you still have that policy for the price that you paid for it today. Does that make sense? So it's portable, it's level. It also pays death benefit, not to your mortgage company, but it goes directly to Mary. So Joe, you die, Mary gets the full amount of the policy, and then she can decide what she wants to do with it. She can refinance, she can pay the house off, whatever she wants to do. And maybe it's so far, maybe it doesn't happen, but 20 years from now, the mortgage, maybe has $75,000 left. She has a $300,000 policy. She just pays a mortgage off, and then she gets to keep all that other money to do whatever she needs to do, right? Whereas those mortgage protection policies that the bank offers, it just pays the balance of the mortgage off, and it's done. So those are some of the advantages of mortgage protection. So when you're talking to a client, it's good to bring up those points so that in their mind, they differentiate it from, regular life insurance. So Daryl, I just assumed all these questions. I don't know. Was there more to your question as far as, were you asking like what policy or what company?
Well, I was going to get to that, yeah, but definitely what company would be good. But again, if from my past experience, we would sell decreasing term. But since it's really just another life insurance product that we're selling, it's just whoever's going to give us the best rate and a term policy that's going to cover the mortgage.
Yeah. So level term. Yeah. We don't have, I don't believe there's any of our carriers that do decreasing term policies anymore. There was one company we had a long time ago, but now the mortgage protection policies are all level term products. The other advantage of mortgage protection doesn't require a blood and urine test. So mortgage protection, so this is kind of where when you're looking at mortgage protection, because there's no blood and urine tests, it'll cover health problems, health situations like diabetes, someone taking pills for diabetes, high blood pressure. It'll handle a certain amount of being overweight. There's a lot of conditions it'll cover without having to do a blood and urine test. And so that's the advantage of the mortgage protection products. So mortgage protection products such as Columbian Financial Group Safe Shield product is a mortgage protection product. Mutual of Omaha Term Life Express is another good mortgage protection product. Foresters has Strong Foundation. We don't do a lot of Foresters anymore. Americo has some really good mortgage term products. But the ones that we tend to write a lot are CFG Safe Shield and Mutual of Omaha's Term Life Express. They get issued pretty quickly. Now, there are limits to the amount of face value you can cover, so let me share with you a cool tool. See. So on the ARC, I like to go to advanced resources. And then resources, product pocket guide. So this product pocket guide is really cool because you can look up, you can compare all the different companies against each other. Okay, so we're talking about mortgage protection, simplified issue term, right? So let's hold on, let me. So you go to product pocket guide, you click on simplified issue term, and it has all the companies and all the term products or the mortgage protection products that we can use to cover a client. And so believe me, I'm not asking you to memorize or learn all these products. Okay. The ones that we like to write that tend to be easy is Mutual of Omaha, Term Life Express, CFG Safe Shield. Actually, I hear a lot of good things about this Prosperity Life product. Americo Term 125 and 100. And CBO 50 and 100 is a good one. All right. But like I said, I just kind of stick, if you're brand new, let's just stick with Mutual of Omaha, Term Life Express, CFG, maybe Forrester Strong Foundation, but maybe these two. Okay. So what's great about this product pocket guide is you can look at which products for simplified issue term, in other words, mortgage term, and you can look at how much it covers. And so you click on Mutual of Omaha Term Life Express, and it has a 10-year, 15, 20, and 30-year term. And then it has the issue ages for those terms. So between 10 and 15-year term, you can issue it up to age 75, 18 to 75. 20-year goes 18 to 60. 30-year goes from 18 to 50. And then it has a return of premium option that can only be issued between ages 18 and 50. You can see that it goes up to 300,000 face value. Return of premium available only on the 30-year plan. You don't need E&O insurance. So you can see some of the things that are important. Okay. Now you can compare it against CFG Safe Shield. So Safe Shield has 10, 15, 20, and 30-year term. So you can issue 10 to 15-year up to age 70, then 20-year to age 65. So if you want to go 20-year only goes to age 60 for Mutual of Omaha, but let's say you have a 65-year-old that wants a 20-year term. Well, you find out that Safe Shield, CFG Safe Shield will go 20-year term up to age 65. Again, you can see certain advantages that some products have over another. And if you go to the product pocket guide, it makes it real easy to see which one you could possibly get into. Now, notice the Term Life Express, 300,000 face value max. CFG Safe Shield is 350,000. Okay. So it's got a little bit, you can get 50,000 more. Again, there's no return of premium program. Okay. And, no E&O insurance required. It's got an e-app available, so on. They won't accept debit or credit cards. So this goes into a lot of detail if you're just trying to compare. So these are the go-to companies that I would look at for mortgage term. Again, I hear a lot of good things about the Americo CBO 50 and 100. And these are cashback return of premium programs that are wrapped up in a UL chassis. I'm not going to go into it really here, but suffice to say that what you can do is you can go, if you want to learn it, you go to the ARC, go to carriers, go to Americo, okay, and then you've got the term portfolio, product training, so click on that. The HMS series, home mortgage series. So it's got the different HMS products, term 125 and term 100. What is it? So on. Then CBO 50 and 100. It's a cashback. So CBO stands for cashback option. So these are return of premium options. Okay. So anyway, so if you want to dig in, now that you know which companies we have for the term, this is where you would go to learn that. So the product pocket guide is really good. Now, if you want to get more underwriting type of advice, you'll go to either the final expense underwriting grid or the mortgage term underwriting grid. So let's just talk mortgage term. So you're writing a mortgage term on somebody, and they have certain issues. So there's alcohol. You can look up, they have alcohol treatment issues. Okay. So it tells you how each of these carriers will cover alcohol treatment. So you can see CFG Safe Shield, decline if, so you see the decline if, in the past 5 years, advised to reduce, stop, or seek treatment for alcohol. Okay, so if their issue was 7 years ago, 10 years ago, 15 years ago with alcohol, then CFG Safe Shield is a viable option for them. Okay, let's say they have bipolar depression. This is a real popular one. A lot of people have this. So what products can cover? Well, CFG Safe Shield, decline if ever, or also attempted suicide. So, CFG Safe Shield will not cover anyone with bipolar depression. How about Term Life Express? Decline if ever, also mental capacity. So we know that Term Life Express will not cover someone with bipolar. Okay. Prosperity Life, decline if ever diagnosed or treatment advised in the past 5 years. So it's only a 5-year window. Americo HMS Plus, decline if ever, including major depression, so on. So they're really hard on bipolar depression. So Alex, what do I do when someone can't qualify because of their issues? Well, then guess what? We go to whole life. Final expense. But Alex, you got a term. Final expense doesn't even go up that high. That's right. So the other option for people that can't get term is mortgage payment protection, right? So they can do mortgage payment protection, which covers, 12 months of mortgage payments for their family, or 24 months, depending on how old they are, or how, they're sick. They can be sick enough where they can qualify for a whole life. So now you're in the mode of doing mortgage payment protection. Sometimes you have to do mortgage payment protection on seniors because they can't afford a term. The term's way too expensive. So our job is to get them covered, and we're going to open them up to 6 months, 12 months of mortgage payments using a whole life product. And when you lay out the options, you don't say, Joe, okay, this 6-month option will get you $6,000 of coverage. No, you got to present it in the benefit with the benefit in mind. So option 1, Joe, this is 6 months that your wife, Mary, can make the mortgage payment so that she doesn't have to short sell the house. She can squeeze out every bit of equity you have in your house if she has 6 months. Now, here's the 12-month option of mortgage payments. I'm not going to say it's $12,000. Like if their mortgage was $1,000 a month, I'm not going to say this will be $12,000 of coverage. Now I'm going to say this is 12 months where Mary doesn't have to ever worry about the mortgage payment. It will buy her time to be able to decide what she wants to do. Isn't it better for her to buy her time? Okay. So sometimes we call it an equity preservation option. So Joe, Mary, this is our equity preservation option. This gives you 6 months of mortgage payments, so you can, really get some time to be able to get every of equity out of your house. Here's 12 months and here's 18 months. Okay. You're not saying it's 6,000, 12,000, and 18,000. You're characterizing it in the term of the benefit, right? That means something to them, right? So, so those are some of the, the mortgage term type of things. But again, I go back to this. These guides are great because you got the underwriting grids that you can look at. You can see diabetes, right? Diabetes is always a popular one to look at. And you can see how each carrier and each of the mortgage protection, final expense is final expense. You can see how the mortgage term, hepatitis B or C, HIV. So this will really give you a good feel for what carriers will take care of that client. Does that make sense, Daryl? Hello, Daryl. Can you guys still hear me?
I can hear you fine.
I
Okay.
can
Yeah, I can
hear
hear
you.
you just fine.
Okay.
Yes.
Yes.
Okay, cool. So, so those are some of the things related to a mortgage protection, and you will run into most of the mortgage protection are really older leads that were given out. We do have a mortgage protection lead that is a $20 lead from one of our vendors. That's a social media lead. So that, so that's an option to get them. But otherwise, the direct mail mortgage protection leads are really, really expensive. And so, and they're hard to get a hold of too, because most agents that have those GMRs out there, they squat on an area and the alliance is not going to give any, unless that agent quits, okay, those mortgage protection leads are not going anywhere else, so kind of first come, first serve type of deal. So that's why you don't hear me teaching a lot of mortgage protection. But again, like some of the older leads that you guys are getting are mortgage protection leads. So, I mean, you really do need to learn your options for mortgage protection. All right. So Daryl, did I cover enough there, or do you have other specifics on that?
No, I'm good. Thank you.
All right, cool. You're welcome.